Guys, a lot to unpack this morning. We're going to begin with futures, obviously. Mike, it's going to be interesting to try to separate some of the spikes that we're seeing in energy from the broader reopening trade. Obviously, we mentioned yields. The president a moment ago tweeting that we're going to break that goal of vaccinating 100 million in the first 100 days. So that's all good news, and certainly equities reflect it.
They do. I think not much has come along that would disturb this view that, we're pretty much on an accelerated path towards some fashion of reopening in the spring. You're doing better than expected on cases. And if you look at the Treasury yield move, that's been just right along a trend that's been in place for a few months now. So it's hard to say that that's, anything like weather related. I don't think it's just oil prices kind of bumping the inflation expectations. That's kind of showing you the markets in general are incrementally relaxing as we go along, almost day to day, just ratcheting higher. And, the question becomes, when have we kind of reached the moment when we've kind of figured it all out and priced it all in? That's hard to say because, right now the market is really just kind of feeding off those same forces. And part of it is momentum. But what's been interesting to me is how if you just capture the S&P 500, so that's the vast bulk of all equities, it's been incredibly orderly and this kind of well-behaved uptrend as opposed to some of the wild stuff you see going on alongside of it. So, right now it's very much a don't fight the tape, don't fight the Fed market, for the moment, even though we can sort of see it becoming a little bit of a everybody's already in the pool type environment before long.
Yeah, David, speaking of the wild things going on alongside of it, you got page one of the Journal this morning talking about junk bond yields hitting levels that at least historically have been associated with no default risk. So this is starting to creep up into not just mainstream media, but the top of mainstream media.
Yeah, I mean, we talked about it, I think, fairly recently as those yields fell below 4% on average, which is truly historic when you think about it. I mean, I can, of course, remember the dawning of the high yield market and Michael Milken in the 80s, helping to create that market, and obviously it becoming a very important area of capital raising for so many companies. But I can never remember a period where, Mike, you're paying 4% or less on average. And we've talked about this. I think it was last week when we noted Carnival Cruise. I think they raised, $3.5 billion at a little more than 5.7%. Again, I'm working off memory here, but I think I'm roughly in that area on 6-year paper, unsecured. I mean, the numbers continue to come in terms of the willingness of buyers to step up in the fixed income markets. Again, attesting to the lack of supply, I guess, for lack of a better term, in terms of anything that's got a decent yield on it.
Right. And we're in this world where it's almost as if capital's not scarce, right? I mean, to say the least. And how do things get valued in that type of environment when capital really is free-flowing and plentiful? And at least the perception is you're backstopped by somebody along the way, whether it's, the Fed or something else. Investment grade yields, again, this goes back to 1 year ago as well. People were saying, well, on an inflation-adjusted basis, if you're an investment grade borrower, you're paying zero. Real yields are at or below zero. And so that kind of changes the equation. It doesn't alter the fact that, yes, equity valuations are elevated. Maybe that means forward returns over many years are going to be restrained. But, it's hard to say what the right price to pay is for equities that, an earnings stream is going to grow over time, dividends are going to grow over time, when you're willing to pay 4% to high-yield borrowers, get 5% from high-yield borrowers right now.
Yeah. David, I noticed IMAX shares in Asia overnight, and even this morning, they're going to open at a post-pandemic high. You got the state of New York broadening eligibility for the vaccine. Goldman had a note over the weekend about pent-up savings, or what they're calling forced savings in American households, $1.5 trillion, and going to $2.4 trillion, 11% of GDP by the middle of the year, assuming there's no more things to derail the economy. They think a fifth of that gets spent in the first year. So I mean, it's one thing to call these antics on the sides of the market wild, but I mean, it does reflect the thought that we're going to be seeing the consumer return in ways that are going to be historic.
Yeah, listen, that's a key point here. I mean, we make note of, as I think we should, the areas of speculation that we see that we haven't seen in some time, or at least that are somewhat different than what we've seen, whether it be certain areas of the SPAC market, or just the proliferation of this, of course, as a vehicle itself, special purpose acquisition corporations, deal after deal being priced and then deals being negotiated, whether it be Bitcoin at 50,000. Again, there are many who can explain it, whether it be certain stocks, Mike, as I look at, that have just had incredible moves. And it's not just the back and forth on GameStop. I mean, look, Viacom and Discovery in my old world, you can take a look at, both up over 55% for this year. And yet, to Carl's point, you've got pent-up savings. You've got this idea that Americans are going to get back to doing a lot of things they haven't been as we start to at least see light here with vaccines being administered at a more rapid pace, with the virus thankfully receding. We are still concerned, of course, about these other variants that are more transmissible and perhaps even more virulent. And with $1.9 trillion as well, potentially getting ready to come in. If the Biden administration is successful in getting its program passed through Congress, wouldn't be a bipartisan, of course, but they could do it if they wanted to through reconciliation. And that could well be coming fairly soon, too, Mike.
Yeah, there's no doubt that the market does best when it's getting help that it maybe doesn't even need. So it's sort of more than covered in terms of the downside risk, whether it be in consumer spending or corporate credit, as we've been talking about. So I think that explains where we are. Does it mean you can just extrapolate it out from here? You know, the pent-up savings number has been kind of a staple of the bull case for months. I mean, you're able to you could look at it in checking balances. It's not some kind of, fancy proprietary estimate. It's there. And it's been part of the bull case since we've been talking about this, for months right now. So you're up 16% in 6 months. The market itself has, really, I think, overachieved in the near term. It feels and looks a lot like, I can throw all these different years out there. But in 2017, where everyone said, is anything going to disturb this market? Is anything going to basically give it pause? Well, what we did see in late January, early February is when a massive stampede of volume is equal to 5 to 7% of overall volume coming from 8 stocks that are going up or down 50% a day, as happened in the Reddit, craze. That was enough to create this positioning shock. And now you have a market where almost nobody's short, where cash levels are very low, and nobody's really kind of clenched up in advance of some kind of an unwelcome blow. That's the backdrop. It doesn't mean the market has to quit going up, but that's kind of the setup I think we have for the next several weeks.
Shepard Smith here. Thanks for watching CNBC on YouTube.